Sandip Sabharwal, who's joining in on the show. Sandip, hi there. Good morning. Lots to chat about, given that we did have a whole host of big numbers, as well as it's going to be a hectic week going by. Let's get in a sense as to what you made of the pharma majors. You had Dr. Reddy's that put out numbers pretty much in line with what the street was penciling in, and Cipla was fairly strong.
Yeah, both results were very decent. Drivers for the results were different for different companies. Some due to higher product prices, some due to lower input costs, and due to OPEX control, etc. But overall, the large cap pharma basket in terms of result typically has been doing better than expectation, and that's also reflected in the outperformance of some of the stocks. Now, at the current levels, these stocks seem to be in the fair value zone. With the view that on dips they should be bought, and they should be bought rather than looking at selling them on that.
All right. In fact, let's put the spotlight then on these pharma majors and hear it out from the management. Umang Vora, the managing director of Cipla, talking about the Q2 numbers. You also have the management of Dr. Reddy's. Listen in.
Revenues was up close to 15 or 16%. Profits grew significantly more than that. I think we've continued to show market-beating growth and traction in all our businesses. We've shown it in India, both in the branded prescription and the trade generics business. In our consumer business, we've seen the same effect that the FMCG companies saw, which was of a slightly slower growth, but I think we're beginning to see that bounce back in this quarter already. I think this quarter had the impact of, obviously of the liquidity situation and a little bit of volatility due to the world context. And in South Africa, we continued the robust performance. The business is growing on the back of strong private market growth. We continue to fund the R&D program at the company. We are now at about 5.7% of revenues. The spending grew by almost 13% versus the year before.
We actually have an EBITDA of 32%, which is very healthy. And plus those margins grew by high double digit. The profit after tax even grew by 33%. So I think for both profitability as well as the growth of the profit, we are in a very good shape. The return on capital employed was 39%, which is also, I believe, very, very healthy. And likely that this performance will proceed also in the future. Most of the growth was volume growth as well as market share, as well as contribution from Maine. These were the main lever, and of course we will help that the level of price erosion is moderated compared to quarters in the past. The growth is coming primarily by giving better service to customers and growing base products that enjoy the fact that we got that service and we were able to pick up market share on those.
All right, those are the pharma majors, keeping the spotlight on them. But getting a take then as to what exactly you're penciling in, Sandip, when it comes to Tata Motors. After a pretty solid set from Maruti, brokerages giving it a thumbs up. What's the expectation from heavyweight Tata Motors?
I guess Tata Motors results should also reflect similar improvements. Although on the domestic front, Maruti would have done much better, but on the global operations, Tata Motors performance is expected to continue to improve with improved margins and improved cash flows. I think the key in Tata Motors, which everyone tracks, is the order book and the cash flows plus the net debt levels which the company has, which they have been continuously indicating they'll be reducing slightly. So those are the parameters to watch. But overall, trend-wise, things looks to be positive. Maruti results are very strong. Bajaj Auto results are very strong. So auto as a segment, as the industry seems to be doing well at this point.
The charts indicating when it comes to a Westlife Food World at about 820 after the decline we witnessed on Friday's trading day. Good time to nibble in. And have you had a look at the charts of an IGL?
So technically, both these names have seen a sharp cut over the last few sessions. You don't want to be buying into a sharp cut unless we start seeing reversal signs. So we've seen a 3-day cut on Westlife. Same is the case with IGL. The stock looked interesting and was on verge of a breakout around 480, got stopped out. And then it has broken all the major swing lows of the last almost 3 to 6 months. So I would still be a little cautious. The stock has been an underperformer. Every time the stock tries to come back, we've seen corrections. The stock is now closer to a support level of 340 to 360, which is a very strong band because that was the low of 2022. So do not expect much of selling pressure from here, but a recovery would wait for some reversal signal. As of now, we've not seen any.
Okay, fair enough. That's the view coming in on the charts. On the flip side, though, on Friday's trading day, you had something like a Wellspun India, which shot up. EIL was up and away. Varun Beverages gained traction. Something like a Jamna Auto, Adani Total as well. Those were some of the smart movers on Friday's trading day. Just Kush, wondering if you've had a look at any of these charts, anything catching your eye?
Something like Varun Beverages. I've got something. One of those stocks on my radar does look like it's probably going to hold on to these levels. We saw consolidation. There was a breakout, but that's more in line with the market, and the recovery has also been fairly decent. So that's something that I wouldn't mind dipping into on the buy side. On the upside, 950 and 980 are the two levels that we're looking at. And on the downside, a 910 or a 900 kind of a level is a support zone. So that's where I would place my stop loss if I take a fresh trade, from here on.
Okay, fair enough. That's the view coming in on the charts of Varun Beverages. But let's move right on then to some more news and updates. And after a successful reverse merger, Max Estates will list on the exchanges today. How does the new structure at Max Ventures affect shareholders? My colleague Vamakshi joins in to explain. Vamakshi?
Well, yes, Max Estates in focus today. The company is expected to list on exchanges today, and this is after completion of reverse merger between Max Ventures as well as its subsidiary Max Estates. Now, the composite scheme of amalgamation was approved by the NCLT bench of Chandigarh back in July 2023, and in fact, the trading consequently of Max Ventures was suspended on August 10th, mainly on account of procedural reasons, and the share price, in fact, on that day was around 216 rupees per share, which was an all-time high as far as Max Ventures is concerned. Now let's look at how the company structure has actually changed over the last few years. Now earlier the company had two business segments. The first one being the specialty packaging business, which was a JV with a Japanese firm, Topan Printing, and the second was the real estate business which it owned through its subsidiary, that is Max Estates. Now the company had actually divested its entire 51% stake in the JV for specialty packaging for around 600 to 650 odd crores, and this was mainly to focus on the real estate segment. So essentially, Max Ventures became a holding company for Max Estates, with real estate being its only business. Now, the idea behind the reverse merger that the company shared was to actually remove the holding company structure and directly list the real estate company. The conversion ratio for the same is 1:1 ratio. So essentially, when we talk about the impact on the shareholders, for existing shareholders of Max Ventures that will get shares for Max Estate, nothing materially changes. It is only technically that the name is changing for Max Estates. So all in all, keep an eye out on Max Estates on the back of its listing on both the exchanges.
All right. Meantime, Sandip, just wanted to get in your take as to what's happening when it comes to some of the chemical stocks, the likes of Naveen Fluorine, SRF, Gujarat Fluoro. Some of them seem to be in a bit of a downtrend.
So I think the chemical space is in a perfect storm at this stage because prices are declining, demand is falling, and the supplies are very huge. And on top of that, many of these chemical companies have announced very large capex plans. And once as those capex plans will hit the markets, that be at a time when the margins are actually getting squeezed. So I think it's a perfect commodity cycle where the chemical companies become most aggressive at the peak of the cycle, start doing a lot of capex, and then you have years of downtrend in prices as well as profitability. I would think that many of these stocks which have fallen substantially from the tops can also fall substantially more from current levels. So people should be in general cautious of the chemical space. There could be a few exceptions here and there which are doing something different, but overall, that's the.
Fair enough. That's the view coming in on some of those chemical stocks. Meantime, there's so many stocks that we'll really be keeping on our radar, tracking the quarterly numbers. You've got Aztec Life, for instance, came out with a loss of 13 crores this year versus a profit last year. On an operational basis as well, it was a loss of about 3 crore rupees. There's M&M Financial Services, where the profits were down nearly 42% at 287 crores. We'll be watching out for a City Union Bank. You have the asset quality, which has moderated sequentially. Profits just about flat at 281 crores. MGL is the other one. Profits have been disappointing, down about 8% YOY, but the total volumes have seen a near 5% increase. That's MGL as well, that we'll keep an eye out on in trade. And IRB Infra, another result candidate, ditto when it comes to a blue dart, where you have seen their margins shrink this time, and revenues have been absolutely flat at about 1324 crore rupees. Route Mobile is the other one that we'll be tracking. A profit at about 88 crores has been down nearly 3.5%, and margins have shrunk to 12.6%. Sandip, wanted to get in your take. Some of these mid-cap PSU banks, how have you read into the quarterly numbers? And do you think that when it comes to the pecking order, it's definitely going to be the large caps, that private banks, that will take the lead?
I would think so, because see, the PSU bank current results seem good simply because of the fact that the write-offs have moderated, there are some recoveries, etc. But these banks are continuously losing their market share in the low-cost deposits, which is the mainstay of banks, which is the sort of fodder for banks to make high profits. And there, the private sector, larger private sector banks are gaining market share on a continuous basis. So I think that's the challenge that PSU banks will face. So I would think they have had a huge rally. The valuations are not as cheap. And my preference still would be banks like ICICI or Axis, which have done very well in the outlook also very positive.
All right, there you have it. Meantime, Kush, wanted to understand from you as well what the outlook is on some of the large cap stocks that were standing out on Friday's trading day. Axis Bank really taking the lead with a 3% gain, and you also had something like an SBI that was a buzz.
Quite rightly pointed out, I think Axis Bank is perhaps going to be, one of the outperformers in the private space. We know the issues surrounding HDFC, and, doesn't look like, it'll rebound anytime soon. Been under a lot of pressure. ICICI, Kotak have, issues of their own going on. So I think Axis is actually our top pick in the private bank space. Not a bad idea to perhaps consider this on the long side, especially if the bank nifty were to rebound. I think, Axis Bank could play a meaningful role here. On the upside, I think 1030 and 1055 are the two levels that I'm looking at. And on the downside, 975, 980 is the zone that, could hold as a support zone. As far as SBI goes, well, the entire PSU bank has been, PSU bank pack has been under pressure. SBI is, no different here. The Friday rebound, in line with the markets, was more of a technical rebound. So I wouldn't really buy into, this, rebound. As long as the stock holds above 575, or when it crosses 575 is when we can consider a long position. Otherwise, this stock will remain in a downturn. Not a bad idea to perhaps even go short on it, till it crosses 575. So SBI could remain under pressure for, some time, but Axis Bank looks strong.
Sandeep, I recall, last week during the declines, you said that, you could add up banks to your existing positions or maybe even buy afresh. And ICICI Bank and Axis, I think, were the preferred ones. But what within mid and small caps, if at all, you recommend buying into the decline?
In the banking space, I personally don't go into mid and small cap banks because I believe the larger banks, unlike many other in market segments or industries, the larger banks tend to do well over the longer term. So that's how I'm seeing, and especially at a time when interest rates are high, etc. Many of the smaller banks have been going on the back of personal unsecured loans, so we don't know what ultimately will happen to the asset quality. So it is time to stick to the leaders, especially in the financial space.
And X of banks, anything that's looking interesting, anything that you may have bought in last week's decline?
So mainly banks and like I've been saying that on autos, things are looking positive. So Maruti, I think, is still pretty well placed even at these levels to give a 15-20% kind of return for the next 1 year. So that's one thing which we've been adding.
Again, Sandeep, within autos also, there's quite the shift which is happening. You've got Maruti, which is now well above the 10,000 mark. You've got a rebound coming in a Bajaj Auto, for instance. So, where within autos is your preference?
The autos overall, I think the entire space will do well. Maruti stands out because it's the underowned stock today, and many people have not bought into the stock because the delivery was not coming in terms of results, and this quarter suddenly they have delivered very strongly, which changes the earning picture completely. So I think that's one stock. M&M we've been holding. Tata Motors is something we've been holding. Bajaj Auto, unfortunately, I have not been holding, but I think the company is doing pretty well.
I wonder if anything within the primary markets or any of the recent listings have caught your eye, because there's really been a flurry of activity within that space.
I agree, and valuations of these companies are just too high. Even the two recent IPOs which are on or coming up this week, with most of it being offer for sale, I think the valuations are too high to justify investments. So we need to see them cool off, like all of us remember the IPOs of Nika and Paytm, etc., and what happened subsequently, and then it presented opportunity to buy for investors much later. Many of these IPOs, I think, will go the same way.
Right. Okay, Sandeep, good to have you on the show as always. We'll let you go on that note.